Joining us right now to talk a little market strategy is Barry Knapp, managing partner at Ironsides Macroeconomics, and Victoria Fernandez, chief market strategist at Crossmark Global Investments. Barry and Victoria, great to see you. Barry, I think I saw you on Twitter saying you had to go to sleep early, maybe, to see us this morning. So I hope you've been thinking a lot about what's happened this last week. But it does feel like, you know, if we had this conversation on Monday to Friday, a lot has changed. And I don't know, but is the growth trade back on? Is that what's happening here?
Well, the growth trade has been performing pretty well for several weeks at least, if not a little bit longer than that. And the initial thesis was that we'd reached peak reopening-related inflation, the so-called transitory piece of inflation. I wasn't going to mention that word because I did hear Becky say yesterday that she's kind of tired of transitory, but nonetheless, that piece, there's no doubt that, you know, used car prices and the like have hit their maximum, you know, reopening related velocity. And so that was a, you know, reasonable thesis. Those of us, though, that believe that we are moving into a higher inflationary environment post-pandemic would tend to look through this. And I would say the same thing with respect to the Fed this week. You know, I put out a note to clients ahead of time saying that the dot plot had to change. It was nonsensical to not expect a rate hike until 2024. But remember, one of the Powell doctrines is that this Fed is far less interested or confident in forecasts than was the case with the Greenspan, Bernanke, or Yellen Fed. He's not a macroeconomist. So I would expect a round of speeches to walk that back, in part because if they let that forecast hang out there, they've now gone from, you know, state contingent forward guidance on asset purchases, meaning getting substantial further progress, to time-based because they've locked themselves into tapering within, you know, a set time frame, say by the end of the year. So I think they're going to walk that back. They're at least two good payroll reports away from tapering or starting the taper process. I think they'll get those. And that process will start in the fall, and then
Barry,
we'll have a decent.
I want to know but before I get to Victoria, how are you positioning your portfolio though as a result of that thesis?
Well, I've been in the reflation sectors, financials, materials, and industrials since the summer. I upgraded energy in December. I do have tech exposure. I've been market weight. My long-term thesis is that the benefits of digitization are going to flow to the consumers of that technology from producers. But I have cyclical exposure in tech, meaning software and semis, in part because capital spending got impaired by the pandemic, but also impaired by the trade war. So we're going to have a really robust recovery in capital spending. In this country, that means software. So I was never underweight those sectors. I've never had the growth versus value trade on in its entirety. I've just been underweight all the defensive sectors and healthcare, REITs, and the like. Right.
Victoria, how have you been positioning your portfolio? And let's just make the point, though. You're talking about some of the inflation stocks. You would have thought banks, but look, Citigroup is falling. You know, you can look at CAT, you can look at Deere, they're rolling over. And people are, you can just look at the stocks of Facebook and Google again, right?
Well, I don't think you want to look all one way or the other, Andrew. You never want to chase the market. And obviously, we've seen this rotation between growth and value and back to growth again. And we like that exposure. We like exposure to the secular growth area. You were talking about Adobe just a little bit earlier this morning. That's a name that we've recently purchased in the portfolio. We like names that have exposure to that internet space because we think regardless of what's going on with inflation, this is still an area that's going to be in high demand as companies build out their IT infrastructure, as people continue to work remotely and they start determining how they're going to allow employees to work from around the world. So we like that exposure. But you do need to look at some of the longer term trends that have developed during COVID and that continue. So you're talking about financials. Maybe the big banks aren't exactly where you want to be, although we do owe JP Morgan. But look at the credit cards. Look at MasterCard and Visa. You get some reopening exposure, but yet you still have that financial, that cyclical play to it if you see rates move higher. higher that benefits them. So I think you need to have a little bit of both in your portfolio. One of our most recent names we bought just over the last week is Oracle, because again, we think it has a catalyst within that cloud software space. So this is a time to really pull out your shopping list. It's not going to be an easy time to build your portfolio where anything works, like perhaps worked 6 months ago. You're really going to have to use your fundamentals, go to your shopping list, and get those specific names.
Shepard Smith here. Thanks for watching CNBC on YouTube.